Hello, and welcome to the 2024 Q4 Market Update webinar. My name is Dan White, one of Ark's associate portfolio managers, and I will be moderating today's call. This call was pre-recorded on January 10th, 2025. With that, I will now turn it over to Ark's CEO and CIO, Cathie Wood. Cathie?
Thank you, Dan, and Happy New Year to everyone joining us. 2024 is behind us, and as you know, we've been characterizing it as, despite what the headline numbers say, a rolling recession. We certainly saw in small business confidence and low and middle income earner confidence a lot of weakness last year. And interestingly, since the election, confidence in both of those groups is bouncing. Now, we know that a transition brings with it uncertainty. And so we're sure that there will be some question marks around how successful this new administration will be in terms of cutting spending, which, of course, is a big concern in the bond market, and cutting taxes. Which goes along with cutting spending, because as we've said always, government spending is taxation. So we know there's a lot of uncertainty, and that could depress activity in the short term unless the new administration makes whatever regulatory changes and tax changes retroactive to the beginning of 2025, taking away that uncertainty. Now, we know the new Treasury Secretary is focused on the risks associated with uncertainty. So hopefully that message is getting into the new administration in a deeper way. In terms of inflation and interest rates, of course, the long bond has backed up in response to fears about profligate government spending. In President-elect Trump's first term, he was a big spender. And so it remains to be seen whether Doge, Elon Musk, and Vivek Ramaswamy will have a real impact. In terms of Fed policy, we have seen interest rates come down. And as some numbers very recently, including the employment report, come in stronger than expected, though they are around the turn of the year, which is subject to all kinds of seasonal distortions. Nonetheless, the fears are that short rates will not continue down for very much longer. If they do not, then what we believe will be the reason is more having to do with real GDP growth than inflation, because we do believe that productivity growth associated with technology is going to lower inflation overall, as will the dollar's recent strength. And that's the last comment I'll make. Why is the dollar so strong? The dollar is strong because investors around the world, we believe themselves that the return on invested capital in the United States is rising relative to the returns available elsewhere. That's a very good thing. The dollar going up is a potent anti-inflationary force because commodities are priced in dollars. And so we're seeing from commodity prices signals that inflation is under control. And if we're right on what continues to happen to productivity, it has already strengthened into the 2% range. If it continues to strengthen, then the 3.9% increase in average hourly earnings that we saw in the last employment report will translate, when incorporating productivity, into something less than 2% inflation. And so the Fed's fears will be allayed as those two trends continue. So with that, Dan, I'll send it back to you.
Great. Thank you, Cathie. We will now begin the question and answer portion of today's webinar. Questions were received from distribution partners, submitted via saytechnologies.com, and sent to our Funds X account at Arkk-Funds. The first question, Cathie, I'm coming back to you here. You touched on it a bit, but with Trump back in office and the GOP's focus on cost reduction, how do you think this will impact the overall market?
Well, we do believe that lower spending will translate in some way, shape, or form into the right to lower taxes. And we do know that there are two very determined people in terms of Elon Musk and Vivek Ramaswamy, who are not only trying to lower spending, but also lower the number of regulations that really impede innovation and have impeded, we believe, innovation, importantly, during the last 4 years. So we think that they will be more successful than those who believe that political forces are so strong they will not be able to overcome them. That is, I think, consensus thinking in Washington. So we think they'll be more successful than that. But 2 trillion by July 4th, 2026, I think even Elon Musk is saying, okay, that's a bit ambitious. Nonetheless, getting the trajectory from up to flat or down, that will be a big change. And if you'll notice, in the 90s, which was the last time we had a budget surplus under Clinton and Newt Gingrich's Congress, that was a very good decade for the markets, especially after the mid 90s. So lower spending, lower regulations tend to be very good for the equity market.
Thank you, Cathie. This next one's for David. David, quite the year for crypto and all digital assets. But for the question, how has Bitcoin and your views evolved now that the spot ETFs have been available for roughly a year?
Thank you, Dan. So we believe Bitcoin is geared towards various emerging trends that increase our conviction in the asset and its active management. I'll give 3 as an example. The first one would be obviously increased user-friendly, cheaper adoption of Bitcoin. Second would be a clearer and more robust regulatory framework. We believe President Trump's new administration, the confirmation of David Sachs as new AI and crypto czar will provide a more favorable regulatory environment for digital assets. Related to these, there are 3 outstanding bills to watch out for in 2025. The first one would be the Financial Innovation and Technology for the 21st Century Act, which will define the scope of regulatory coverage between the SEC and the CFTC. Secondly, the Payment Stablecoin Act, which provides more clarity regarding stablecoin regulation in the US. And third, of course, the Bitcoin Act of 2024, dealing with a proposed Bitcoin strategic reserve in the United States. And then the third potential trend that we see coming through is specialization in Bitcoin product suites and active management generally. Now that the ETFs are readily available in the US, we believe you're going to see a gear towards specialization in active management around Bitcoin's volatility. This will become kind of like a required field in terms of active management, dealing with the asset. Case in point, alternative financial sources of information like on-chain data will become essential to analyze Bitcoin and its supply and demand dynamics over time.
Yeah, thank you, David. On-chain becomes interesting too with the likes of Coinbase and being able to see their base network over time as well. Cathie, to you on more of the portfolio side. So we see the Arkk spot product, ARKB, in a couple of funds like ARKW and ARKF. Why is it not in the ARKK product?
What we're doing here is responding to client requests. As you know, our confidence in Bitcoin and its appreciation from here is very high. And you will see a lot more about that in our big ideas, which we will be releasing within the next few weeks. So why don't we have it in K? K is a generalized transformative innovation fund, and it does have exposure to all of our major technology platforms, including blockchain technology, but indirectly, like Coinbase and Block, which I believe is going to be renamed XYZ, or at least the ticker is XYZ. So indirect exposure. The other two funds, ARKF and ARKW, thematically, Bitcoin is extremely relevant to fintech, which is a big part of both of those portfolios. And so we have allocated a Bitcoin position specifically to them, ARKB.
Thank you, Cathie. And of course, just because a client holds ARKK doesn't mean they can't hold ARKB on their own as well and sort of manage those exposures on their own.
Yes, and in fact, we have found it interesting that many of the platforms out there do not or have not added one of the spot Bitcoin ETFs, and yet they can gain exposure to it through ARKF and ARKW. We, as I said, we were responding to client requests based on differences in opinions among organizations, some really wanting direct exposure, others not wanting direct exposure. And so ARKK is where we give them that choice.
Great. Thank you, Cathie. Moving into the AI world here, Frank, do you think China's breakthrough in low-cost AI models will impact the current trends in AI investments?
Sure. Yeah, this question is referring to DeepSeek and their latest model, DeepSeek version 3. This company is a China-based AI lab that was founded as a subsidiary of actually a quantitative hedge fund in 2023. That fund is called High Flyer, and it was founded in 2015 for the purpose of using new AI methods to do quant trading. And they've been quite successful in creating some of the best open source models coming out of China. This most recent version is a model of similar size to Meta's Llama 405B. So this is the bigger, more expensive one. And they actually trained it for about 1/10 of the cost in terms of GPU hours with similar or even better performance. And so to give some background here, we've observed strong cost decline in AI generally as an enabler, 75% reduction in cost to train models per year, and inference costs have been falling even faster at 90% per year. And we generally think that half of these costs are coming from hardware improvements, generation on generation from companies like NVIDIA, and then software improvements where you have AI scientists coming up with new methods to train models more efficiently. And one hypothesis here is that because China and companies operating in China are relatively compute constrained compared to the US because of the chip restrictions, they've had to be much more innovative on the software side. And that DeepSeek has discovered a lot of algorithmic efficiencies here to make up for their deficit in compute. We're so early in understanding approaches to generative AI that there's probably a lot of room for these efficiencies on the table. And that's actually why we invested in Mosaic AI and the Arkk venture fund that was eventually acquired by Databricks because they were seeking out these exact types of algorithmic efficiencies. Another potential factor is that they've played looser with general convention in acquisition of training data that allowed them to kind of get a leg up in how they came to market so quickly. The truth is possibly somewhere in the middle, but a thing to watch for on how much is factoring in on the former versus the latter is if they're able to actually start leapfrogging frontier capability rather than just meeting it quickly and efficiently. In terms of implications for forward investment, I think we're still very early in what the final architecture for AI looks like. And I think inference time compute is a good example of this, of a new way of using compute to reach new capabilities. And that going forward, cost declines are kind of this requirement to unlock greater capability, and in unlocking greater capability, driving more demand for AI compute and AI investment. So I think we'll see both simultaneous cost declines and increased investment over the long term.
Frank, I'll just add something there. I find it so interesting that throughout the years, China has been known for its ability to innovate more on hardware than software. Software has really been much more US specific. And so necessity is the mother of invention, I suppose. The blocking China from certain kinds of hardware has helped them to increase their abilities in software. So, and it also reminds me in the early days of auto quotas. I forget who put on the quotas, which president, which administration put on the quotas, blocking Japan from selling its commoditized cars in the United States. What happened as a result is they became very good at the high-end cars, which were not did not have a quota. So again, be careful what we wish for as we're putting on sanctions and tariffs and so forth.
Thank you, Cathie. You mentioned earlier the Big Ideas release. No spoilers, but something tells me there will be a lot of AI in this year's release.
Absolutely, absolutely. There have been a lot of breakthroughs, and so the big ideas are rich with AI, which is going to touch every sector. And as we've said many times, AI is the biggest catalyst to innovation out there and to the convergence among technologies that we are anticipating in the years ahead.
Absolutely. And into a space that will certainly benefit greatly from AI. Unfortunately, the genomics world in 2024 and the ARKG strategy was a major laggard. Brett, Nemo, what gives you confidence that 2025 will be a better year?
So yeah, 2024 was a tough year for the genomics space, and we believe largely due to significant macroeconomic headwinds. But we believe 2025 will tell a different story. And why do we think like that? So because we need to start viewing genomics and healthcare more broadly as the ultimate big data sector. Creating value in this space requires a true paradigm shift, focusing on the intersection of biology, engineering, and compute driven by data. So we believe 2025 marks the beginning of a transformative era due to the convergence of three critical factors. First, advanced genomics tools are now enabling us to decode biological data with unprecedented precision, scale, and very low cost. Second, AI has reached a point where it can effectively analyze massive, complex data sets, turning raw data into actionable insights. Third, the emergence of practical application layers like diagnostic screening, minimal residual disease monitoring, AI-driven drug discovery, and even curative therapies are driving real-world impact. So in addition to these factors, we are seeing that big tech companies are also adopting the big data view of the genomics. And this is evidenced by strategic investments and advancements. For example, NVIDIA had a substantial investment in Recursion, as well as in 10 private biotech companies, highlighting the growing intersection between technology and the life sciences. Alphabet, through Google DeepMind, has developed AlphaFold, a game changer in molecular structure prediction, which has already started transforming drug discovery. Furthermore, Microsoft, Amazon, and Meta are also entering the space, and the most recently, AMD has invested $20 million in Epsi, which is a leader in AI-driven biological discovery. There is another kind of piece of the puzzle here that we are thinking about. And so the second layer of the optimism that we see here is the political and the regulatory environment. We anticipate that the new administration will play a crucial role in driving growth in genomics by promoting deregulation, which will spearhead innovation. Moreover, there is a clear focus on developing curative therapies rather than continuing the status quo of chronic disease management. And this shift in priorities is expected to stimulate significant advancements and unlock the full potential of genomics in the year ahead. And to be more quantitative, Brett can add some more of the information here.
Yeah, I mean, I think that on the regulatory front, first of all, also allowing companies to actually do acquisitions is really important to this space, and the FTC has prevented acquisitions from happening, which really in sectors like multiomics, where the companies are often spending a lot of capital to try to finance, cash flow that is sometimes years away in drug development. If there's not a strategic bid for innovation assets, it can restrict price discovery. So without M&A activity, it's actually constrained these companies' negotiating leverage versus the markets versus acquisition, and really restricted their ability to kind of expand their franchises. And we think that's going to materially change in this year, and so should provide some price support across the board for these innovation assets that we see as strategic. Now, why are we certain that they're strategic? It's because we think that the return on R&D to innovative approaches, particularly to drug development, is just going to be materially different than it has been in the past. At the present state of play in the industry, companies are spending 12 and a half years and $2.4 billion adjusted for the cost of capital to get a drug to market. We think with AI, the current drugs that are now entering clinical trial look like they're on track for reducing that cost to 1.5 billion, and we think it'll reduce further from there to 600 million to get a drug to market and save 5 years in the process. And so you can imagine spending much less to get a drug to market results in much better return characteristics on your R&D dollars spent. If you get a drug to market earlier, you also have a longer time to kind of commercialize that drug before your patent expires or before competitors enter the market. And so, saving 4 to 5 years in getting a drug to market, which is what we anticipate will occur, can actually increase the value of the commercial asset you have by 70 to 80%. So less cost spent, get to market earlier, and a better revenue curve. And then if you're delivering a cure to the market, and I think this is the third and actually a really key reason to be optimistic on the space, the financial characteristics of curing disease, we believe is widely misunderstood. And so even if I am giving a patient medicine monthly that totally eradicates the disease, but they still have to take it monthly, that asset, that commercialized asset actually turns out to be half as valuable, a little less than half as valuable as a one-time dose cure, because a cure allows you to capture the entire lifetime of patients' medical spend up front, and you avoid the competitive pressures that are going to come later in the life of the drug. And there are, there's a cure just commercializing now for sickle cell disease and CRISPR Therapeutics asset. And we just think that people don't understand the dramatic commercial potential of these cures. And sickle cell disease is the leading kind of disease being cured right now, but there are a number of assets in pipeline that are going to commercialize over the next couple of years. And if sickle cell disease and Casgevy proves out to be as commercially successful as we think it's going to be, that'll read through into people's value of those other assets.
It's interesting, just to add on to what Nemo and Brett just said, as we have interviewed for multi-omics analysts, one of our questions has been, how would you value a cure versus a chronic solution to a disease? And almost to a person, the answer has been, a cure is one and done. It's, it's worth much less. And you'll see in our big ideas, again, we'll put it out in a few weeks, a completely different way of thinking about that. How much more the patents associated with cures are worth, as Brett said, as you pull more of the revenues forward. And the other thing that we think is interesting is if we are talking about cures as solutions, what will happen is the 85% of the healthcare budget, which is nearly 20% of GDP, that is now devoted to sick care, can shrink and be allocated more towards healthcare and cures. So we think it's going to be very exciting. Now, you might ask, since the question was about 2024, weren't all of these exciting developments obvious in 2024? Well, yes, they were to those of us who are doing deep research into this space. But what has happened to the innovation space, certainly since 2022, is that there's been three massive headwinds. The first one has been valuation. Valuation hit a high in early 21, and as interest rates went up, we've had a complete reset. We're down near the lows that you'd see in our strategy over many, many years. A second headwind has been interest rates that are moving from an upward trajectory to at least flat to slightly down in the next year. And perhaps most important is, as a headwind, has been the convergence towards very few stocks in terms of outperformance. And if we're right and the bull market starts to broaden out under this new administration, deregulation, lower taxes, and so forth, then that should accrue to the benefit of all of our strategies, but especially ARKG, which was the most disadvantaged from those three headwinds.
Thank you, everyone. And I'd encourage the listener to just take a look at some of the research online. You'll find this in written form, and the team's done a lot of hard work to make such a complex topic easily digestible. The next one here for Sam, we actually have two for Sam coming up, but the first one, given that space is not extremely human friendly, has Elon ever mentioned any type of use of Optimus Bots in SpaceX and off-planet efforts?
Yeah, and this is pretty easy. And you just heard from Brett, and the response was actually to a post on X from Brett, and Elon explicitly said that on the uncrewed Starship missions, which will hopefully take place in 2026, the payload would be Cybertrucks and Optimus robots. I think you can also imagine some sort of power generation as well. And then the exciting thing is, if all of that goes well, and he said this, if it doesn't increase the crater count on Mars, then 2 years after that, hopefully send humans as well.
I hope robots on Mars is getting plenty of our listeners excited.
Robots anywhere should get people excited.
A good point, touche. Next one, again, staying here with you, Sam. A name that the audience is asking about. What are your views on AST Space Mobile?
Yeah, so for context for listeners, AST Space Mobile, they've launched a handful of satellites up, and their goal is really targeting this direct-to-device capability. So these are extremely large satellites aiming to be able to connect to existing phones without any modification. It's a name that we've been following for a while. They do have a lot of partnerships. I believe AT&T and Verizon have signed some partnerships with them. There's currently some interesting dynamics occurring. Legato Networks is going bankrupt, and I think AST Space Mobile is taking up some of those assets as well. One of the things we're watching here is really as SpaceX continues to surprise with the rapid development of their capabilities, how this market shakes out and where the economics go. But it's definitely a name that we're watching closely in the space economy.
Thank you, Sam. Our final question here, Cathie, I'm going to come back to you. Judging by it, I'm guessing it's a detailed-oriented investor we have here. So he or she asks, I understand why Tesla is a large weight in ARKQ, but why is it nearly the same weight in ARKK?
Excellent question, and will help me explain the way we're looking at the world. I mentioned earlier the convergence among technologies. The first thing, with the largest catalyst being AI, we believe that Tesla is involved in the largest AI project on Earth. And I know Elon agrees with that. And the other thing is that Tesla embodies this idea of the convergence among technologies. So it is the convergence among three of our platforms. Robotics, we just talked about humanoid robots, but the cars are robots as well. So robotics, energy storage, autonomous vehicles will be electric, and AI. So those three innovation platforms converging in the form of Tesla is why it is such a big weight in both ARKK and ARKQ. And I think that this year, now that we are so close to the launch of Tesla's autonomous strategy, analysts have to incorporate it into their models in a way they did not before. And what's also interesting is Waymo, many more people are becoming used to this concept of autonomous. It's not in the future. It is here. Waymo has already launched commercial services. And so there's no if anymore. It is when for Tesla. And we think that moment is this year, very high probability. And one thing that I'd like to reemphasize, I know we've done this a few times on this call, we will also have a lot on this topic, Tesla and autonomous generally, autonomous mobility generally, in our Big Ideas piece, which will be out in a few weeks. So stay tuned.
Great. Thank you, Cathie, and thank you, team. This will conclude our webinar. We will briefly show performance statistics that can also be found on ark-funds.com. Thank you to everyone who listened to today's call, and thank you again to the entire Arkk team.